Welcome back, all you handsome devils. In this video, we are going to be talking about Vanguard dividend ETFs. Look, if you've been anywhere in the stock market last 100 years, chances are you've heard of Vanguard. Also, if you know my channel, you know we love dividends. In this video, we are going to put up VIG versus VYM, two awesome low-cost Vanguard dividend exchange-traded funds. We have the dividend appreciation ETF versus the high dividend yield. And of course, we're going to look at total return, expense ratio, number of holdings, sector diversification, annual yield as a percentage, equity style, and volatility. So without further ado, let's put on the gloves and jump in the ring. And with the magic of YouTube, we are now inside my computer. As you can see here on screen, we have the portfolio analytics tool set up. We are going to enter the first ticker symbol, which is VIG, Vanguard Dividend Appreciation ETF. We're going to add $1,000 to this one. And also, just so you know, the analysis that we're going to generate in this video is just a sampling. If you want the full, complete analysis, PDF, plus 3 or 4 of my favorite US dividend ETFs outside of Vanguard, click that link completely free. You can download all of this analysis, everything like that, again, with that link in the description below. So let's go ahead and compare to a second portfolio, and it's going to be VYM, ticker VYM, and we're going to do dollars, and let's do $1,000. Let's make it an even battle here. And we're generating the analysis. The program is thinking, it's compiling, it's comparing, it's displaying. So here we are, and the first thing we can see right off the bat is, of course, Vanguard, most of us know, is famous for their very low expense ratios. Expense ratio is simply the cost of doing business, the cost of owning this product, and all of the benefits and risk that comes with it. So we have an expense ratio on both of them completely even. It's like brother versus brother in this situation, with both of them being Vanguard. 6 basis points. That is pitifully cheap. Pitifully cheap. If you think that's expensive, you should go play in traffic, hypothetically speaking. For every $1,000 someone invests on a 6 basis point expense ratio, that is 60 cents per year that it costs you. Very, very cheap, pitifully cheap. So now let's go down to the portfolio yield. So the 12-month portfolio yield on VIG is 1.77% versus the 12-month portfolio yield on VYM, high dividend, which is 3.13. So right here, we have a pretty significant difference. Now, a lot of people are asking, wait, why the difference? They're both Vanguard, they're both dividend funds. One focuses on increasing dividends, so you'd think it'd be a high yield. The other focuses on high yield, high payout, so that makes sense that it's 3.13. Well, let's hop over to the fact sheet. I think it's really important that all investors take a look at the actual fact sheet of the ETF. So this is VIG, the Vanguard Dividend Appreciation. And so let's see the investment approach and the benchmark. So this seeks to track the performance of the NASDAQ US Dividend Achiever Select Index. Well, what does that mean? So it's a large cap equity emphasizing stocks with a record of growing their dividends year over year. Okay, well, let's take a look at this. Includes US common stock, history of increasing dividends for at least 10 consecutive years. Okay, so we know that every stock in here has increased their dividends since at least 2009 consecutively. It also excludes real estate investment trust, REITs. All that is real estate stocks, so to speak, and which generally do not benefit from the currently favorable tax rates on qualified dividends. So REITs typically are taxed as ordinary income, where dividends are typically taxed as capital gains, which is a lower rate currently as of the time of this video. And so that's what that says here. So this one has no real estate, and the companies have to have increased their dividend minimum 10 years. Okay, so now let's take a look at the other one, VYM, high dividend yield, and it seeks to track the performance of the FTSE High Dividend Yield Index. Okay, large cap equity, emphasizing on stocks that are forecasted to have above average dividend yields. All right, this also excludes REITs, which generally blah, 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 what we talked about. Okay, includes stocks with the highest dividend yields. Interesting. So as you can tell already, VYM is focused on high yield, high current yield, whereas VIG is focused on increase. Might not be the highest yield, but consecutive increases, which I like both, but let's dig deeper and see which continues to be better. So of course they're both US, so we're going to see a lot of red in here, US stock, mostly US. And let's take a look at the trailing returns. These are total returns. This is capital appreciation, which is growth of the fund, plus the dividends reinvested. So for the past decade, holders of VIG would have experienced 12.83, and over here, VYM would have experienced 13.05. Very, very interesting over there. Now let's take a look at the equity style. This is really interesting actually, and this will kind of give an idea of why you see different yields and different performance, and they are different exchange traded funds, believe it or not. So over here, what we see is large value, okay, would be in this box, and let's say small growth would be in this box. So neither of the two ETFs have really any small cap exposure, a little bit of mid cap in some of them, but large mostly. And so you'll notice that VIG is really a blend, but it does have quite a bit of growth, quite a bit of a blend, and a little bit of value, whereas VYM, the high dividend yield, is mostly all large value. These are companies that traditionally aren't growing in size much anymore. Think of like Coca-Cola. They're not technically growing in size. They've already expanded, whereas growth would be still constantly growing while also paying a dividend. So as you can see, this has a lot more growth stocks, whereas this has a lot more value stocks. It's a huge difference. All right, so now let's take a look at stock sectors. How are we diversified? Well, okay, so over here on the Vanguard dividend appreciation, we have communication services in at about 3.7%. Over here, we have about double that in VYM. Energy, 0. That's a big difference here. So we have 0 energy, but over here we have 8.5% energy. That's a big difference between the two. Industrials is a significant difference, 23% over here in VIG versus only 8.11% over here. Technology, we're coming in at about 10.5% and about the same over here. Basic materials, about the same across the board there. Consumer cyclical, wow, okay, so this has about double the amount. VIG has double the amount of consumer cyclical. Financial services, pretty big difference there as well. Both have 0 real estate essentially. Consumer defensive, consumer staples, these are things that we constantly need to buy in all market cycles. 16.5% here and about the same there. Healthcare coming in at about 12.7% and about the same there. Utilities, decent difference there. So overall, they're fairly the same as far as sectors goes. There is some big differences, of course, with industrials and some other ones like that. Let's see here. Let's go over to beta. How volatile is it? What's interesting is they both have the same beta. This one has a negative alpha. This means it has not performed, it has not exceeded expectations, so to speak, whereas VIG has. Now let's go up to, let's see how many stocks that they have inside their portfolio. Let's go to performance and risk. Let's make this fair. Let's view and edit all. Let's do a custom one. It likes to go back to, let's see, let's choose, let's just say like right before the major crash. So let's go 6/1/07 versus, and then all the way up until just recently. Let's see if it'll do it for us. 01/2019. Let's reinvest everything. Let's see how it does. Okay, here. It's thinking, it's thinking, it's thinking. All right, so here we are in June of 2007 and all the way up. You can see they track pretty closely, almost sometimes identically. But over the past couple years, VIG has really kind of outgrown VYM. Again, this is the growth factor. See, this is where we see a lot more growth stocks. It's going to outperform in strong bull markets. Although what you'll find interesting, actually, you know what, VYM still has the same amount of volatility. So, you know, you're not getting much there, but you are getting a higher yield with VYM. Another way to look at performance is the worst and the best time period. So let's look at the best 1 year. It's from March 2009 to 2010. The recovery, 44.75 and about 54.80 on this one, which is interesting. The worst time periods, March 08 to Feb 09, negative 35%, negative 44. So this one is a little bit more volatile over the past decade or so. Let's look at some more metrics here. And again, if you want all of this, read through all of this stuff, you can click that link and download this. Let's go to the, Again, this will show you the different type of equity style. Here's a big difference. Number of stocks, 183 in the Vanguard Dividend Appreciation and 406 in Vanguard High Yield. So that's what's really interesting is you have a lot more stocks in VYM than you do in VIG. And again, then we come down to the sectors here, and then of course we have the geographical diversification, but these are solely focused on America, or excuse me, North America and US specifically. So when people say, gosh, I love both ETFs, so what we can do here is let's go ahead and just get rid of portfolio B, okay? Let's go back here and let's say, let's add this one. So let's do a 50-50 portfolio, and let's do percentage, and we'll do 50%. And so let's say if we just divided the $1,000 among both of them, and now we get the best of both worlds. We get high yield, plus we get the dividend appreciation. So now we own a total of 528 stocks, and let's take a look at the overview here. And we have a 2.45% yield, but again, that's constantly increasing. And as a percentage, when you think about it, the percentage is being pushed down because the ETF itself keeps appreciating in price. And through that, you see here's the actual total returns here. What's really nice, gosh, 1 year, almost 15%, but over 10 years, this beats the pants off the S&P 500. So as you can see now, you have a nice mix of all those large companies. You have a little bit of mid, but a 10-year return of 12.96% average annual total return, which is really nice. So if someone asked me, Kenny, which one would you buy? And also now you get some really solid sector diversification as well. You're not really light in any areas, obviously, except for real estate. But that's what I like doing is I like adding several ETFs. No one says you have to pick 1 or 2 or 3. You can really do whatever you want in your own portfolio. Of course, wherever you invest, just make sure it aligns with your goals and your risk tolerance, and never take any of these videos as financial advice. These are just fun experiments and analysis that I like to do. With that being said, thank you guys so much for watching. I hope you enjoyed this video. In the next upcoming video of this series, the comparison videos, I am going to do international dividend ETFs. So thank you guys so much for watching, and we'll see you guys next video.